This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Good day, how you going? Phil Tarrant, host of the Smart Property Investment Show. I hope you're well. Wherever you're tuning into this, no doubt you're probably on some sort of summer holiday, like most of Australia, which is cool. Good time to reset, recharge, think about the future, think about your direction in life. And I'm not talking from an emotional or a relationship level. That's sort of outside of my wheelhouse, and definitely not qualified to chat about that sort of stuff. But from a property investment point of view, still not qualified to chat about them, but just a journalist. My job is to bring people in who actually know about what they're talking about and to help you keep you informed, make better decisions in relation to wealth creation through property investment. And for a lot of Aussie investors, you would have heard about, it's a sort of constant narrative on the Smart Property Investment Show about getting the right team around you. And largely that's a really good, as a property investor, so, a mortgage broker, absolute given. 70% of all mortgages now are written by mortgage brokers, which is a testament to the support they give Australian consumers. Most of you will have a good accountant. And if you don't have a good accountant, I recommend you get a good accountant pretty quickly. They can be all that is make or shape your property portfolio, how you structure it, what the tax consequences of it. Some of you may be using a buyer's agent, and they seem to be growing in popularity. And there's also another person you should be considering as part of your team, and that is a financial advisor. And we don't really sort of get them on the show very often because there's this sentiment that financial advisors, wealth managers, wealth advice practices typically don't recommend property because they don't think it's a good asset and they probably don't sort of earn a fee on it. And I think that's a bit of a misnomer. So what I've done today, I'm going to try and reset everyone's views around financial advice practices, financial advice professionals. Look under the hood, see how these guys tick. Adam Drinkwater, he's a partner at Trayster Wealth. He's come in, and I think he's going to be happy to talk about plenty of stuff. Adam, how you going?
Morning. Well, yourself?
Really well. It's good for you to come in. So a lot of property investors don't like financial advice people because they think that if you go and see one of them, they're going to sign you up with some life insurance straight off the bat and just sell you stuff, right? They don't like property because they don't make any money out of advising in property. They're more sort of other asset classes, equities or bonds or ETFs or whatever it is. Probably wouldn't put you into fine art or wine, a good advisor. Maybe a little bit of a side bet. But is there any truth in all that? Do financial advice professionals like property?
There's probably a bit of truth in the history, I would suspect. So I think historically some of that is probably true in our industry, where in the past perhaps advice was born out of product first and not the person first or the advice first. So advisors perhaps looked at things that they could help clients with or perceived help clients with and kind of charge through. If you're comfortable in providing advice first and doing fee-for-service advice and in the best interest of the person you're trying to help, then it's person first and it's what do they want to do, what do they want to achieve, how can you help them? And if property is part of that, then great. If it's not, then so be it. I think you've got to be comfortable that you provide a great advice service and you have a great fee-for-service model, which frees you up to provide the correct advice for people. Yeah,
sounds reasonable. So some terms there that you're using, like people first, advice first, fee for service. Let's start with fee for service. What does that mean, fee for service?
Yeah, so earlier I think you referenced charging based on accounts or charging through investments and that kind of thing. Certainly a part of our world in the past. Fee for service for us should be spending a bit of time with the client trying to understand what it is they're trying to do. And how can we help them? And what are the benefits? And if that's the case, then what is the charge for the service? So it's based on the service, it's based on the value, it's not based on the account, it's not based on the property. So I think you referenced in your previous podcast about a buyer's agent, for example. They might say, this is what we're going to do, this is the fee we're going to charge. And it's the same for us. So if there are 3 things, 5 things, whatever it is, however many meetings per year or whatever the work is, then here's the fee that it's going to cost you for the year. Here's the value, and that should be the way it's approached.
So the logic then is, if you're paying money to someone to advise you, they're working on your behalf and in your best interest. And there's legislation around sort of best interest and stuff, and it's changing and stuff.
Yeah.
So if you're getting a free service from someone, they're still getting paid somehow. But so typically they're probably potentially not acting in your best interest. Is that fair?
Possibly. I think that's some of the things that have been trying to be removed from our industry for a number of years. So the days of buying a product off a certain company and the advisor being remunerated via the back door or via a commission, which led people to sell products essentially and not sell advice or not give advice. So it should remove those types of things. And some people may or may not be aware of that. So they may think that they're not paying for something, but an advisor may be remunerated via products. And look, some advice practices or some practices may be set up that way and disclosed to their clients, and that may be their model, and so be it. Okay. But from a pure form of fee-for-service advice and providing advice, it's getting in front of people, understanding who they are, what we're trying to do to help them, what is in their best interests. And then just saying, this is the cost of the work, and would you like to do it?
That's the way you do it. And you know, it's a really important point, you know, buyers agents, financial advisors, fee for service. You look at mortgage brokers. Mortgage brokers are, you know, they work on your behalf to find you the right product. But they're paid by the bank, right? They receive a commission, and obviously the Royal Commission looked deep into that. And I think a lot of numbers have come out of it, that Australians really value the role of mortgage brokers, and they didn't change the way in which mortgage brokers are paid. But there is a lot of rules and regulations around how brokers need to be acting in your best interest. There's a lot of compliance around it. Same applies inside of financial advice, right? Yeah. You know, you guys got to keep reams of
I think we're the most heavily compliant industry getting around at the moment.
Yeah. How do you sort of find the balance of providing good advice and the compliance rigor you need to have attached to it?
Oh, look, the balance can be tricky at times from the perspective of how much compliance is involved. And ultimately, the more compliance that's involved, sometimes clients can perceive that as difficult to deal with or to work with. So I think a lot of people would like to sit across a table and someone would tell them what to do and they would walk out and get an invoice. We're certainly not that industry, but you know, it's done for a reason. It's done to protect people. It's done so people understand what has been given to them in terms of advice, and it's in their best interests. There's probably a debate about over-regulation and under-regulation and how far you swing on that. So I think there's probably a few conversations going on at the moment about making it a bit more sensible, because one of the big challenges in Australia is there are some frightening figures about how few people access advice, financial literacy figures in Australia, which are frightening again. And a lot of that is because the over-regulation makes it harder for people to access it. So it's very well regulating and making sure that people are doing things in the right way, but you've also got to make sure that people can access it.
Yeah, and that's the big issue. And some people have tried to crack it and they haven't really been successful. I was chatting with a senior banker over the weekend around this notion of accessibility to advice. And most Australians don't have access to advice. And some companies have tried to provide it at different levels, but it's either too expensive or the education around the value and benefit of it isn't as good as what it should do. What needs to happen to shift the needle, do you think, on more Aussies getting advice?
Probably an easier access point or a more affordable access point. So the more regulation that exists, the more work or the more compliance needs to be done by advice practices, and therefore the cost increases. Ultimately, the end person has to pay for that. So if there is something that makes that process a little bit simpler or easier or scoped and provides an easier or lower or cheaper access point for people, then that would probably help on broad numbers. But it is a bit of a challenge, unfortunately. I think it's something like 10% of people seek advice.
Most people's wealth management strategy is their employer pays, was it 10.5% now of super? Is it 11 yet? 11%? No, it's still 10.5. And that's it. Like, so they go, well, I don't need any financial advice because I'm told put your money in your superannuation, buy a family home, pay it off, and that's the great Aussie dream, right? But I think things have changed a lot. But you know, for property investors, why would a property investor need a financial advisor to be sort of keeping an eye on what they're up to?
Yeah, I think the first point's quite a good way of answering it, because 10.5% or whatever your employer puts in your super fund is incredibly different for each person. So is your lifestyle and so are your needs. So 10.5% for you might be radically different for someone else, and you might have a huge family or desires to do things and the next person does not. So the property part is in somewhat the same in terms of if you want to do it, then how do you do it? And there will be people out there that are really well versed in property or well educated in it, and maybe they don't need advice. But there are some people who really aren't, and they don't understand structure, they don't understand the asset class, and they really want to do it for whatever reason. It's a family thing or it's a cultural thing or someone's told them, you know, there's many drivers. But if you don't have the literacy and the understanding to do it, you incorporate quite a risk in jumping into something that you don't fully understand. So there's a space there for advice where we can work with people to help them understand and say, okay, if you want to do that as part of your broader plan or your life moving forward, then these are the many things that you need to factor in. It may be other people as well already have a set of circumstances and they want to incorporate property into that. So how do they adjust what they have? And there's very phases of life as well. So lots of accumulators who want to get on the ladder. The other end, you might have decumulators who want to retire, finish up, want to get rid of some property, but don't understand how do I do it, or what do I do if I do that, and where do I start drawing some money out of my asset pool to live life and enjoy retirement. So there's lots of different spaces, I would say.
It's complicated. And I think that's in many ways why people, when you dig deep into financial advice, and it's just layers of an onion,
It is.
That sort of keeps pulling it apart. And I sort of want to get into that. We're just going to a quick break. Stay with us, everyone. Back in a moment. Welcome back. Phil Tarrant, host of the Smart Property Investment Show with Adam Drinkwater. He's a partner at Trace the Wealth, sort of running through financial advice. And I must admit, most property investors, it's funny, and I'm probably one of them as well. I'll sort of to close it up front, where I'm all for having a balanced investment portfolio to prepare for the future, whatever that is. But even though I sort of go outside of property, I'm largely disappointed when I do. When I'm inside a property, I can control the outcomes better, is my view. So I sit there and go, well, financial advice, what more can a financial advisor do for me? And that's how, a lot of property investors would think. Do you come across these people all the time who are just going, no, I just want to do this? Is your job to challenge and prod and understand their philosophy and try and get them either confirming their biases or trying to do something different? Yeah,
we do. And a large part it can relate to what experiences you've had in the past. Your experiences might be great in property and poor in other things. It might be vice versa. I meet all walks of life with regard to that. Bias is a great word to use for this, because some people will have a bias towards a certain thing. And I suppose my job is not to interrogate people to the point of butting heads, or, if you don't need advice because you know enough about property, then so be it. However, there is a space there to ensure people know enough about what they are discussing or the things that they are potentially not seeing in their space. So, you may know a bit about property, but you may not understand everything that goes around it and the biases that come with that as well. So, quite often if I ask where the views come from or the information comes from, it's not uncommon to hear someone say, I was chatting to a mate at a barbecue and he said you should buy a property. So now I'm sat in front of someone who tells me that that's the only thing they can do. That's the only information they got. So there's a space there to help people understand, okay, what does that mean relative to other things? And if it's right for them, then great. Do they do it in the right way? So how do they go about structuring debt? What entities are they using? What's their tax situation? How many are they trying to do? What age are they? What stage of life are they trying to build all this up for? So I think you mentioned earlier, you're happy being a balanced person. That kind of term gets bandied around a lot. Yeah. What does it mean really? Your balance can be different for each person. So a lot of it is about understanding that. And do you need to go out and stretch yourself or not? Could you have a really great life ahead of you based on your values and what you really want for life without doing all of these extra things? So it may be that you need to do some of those things, but others don't. So you kind of got to start out with who the person is. Yeah. What does great look like for them? What are their experiences? And then help them take the right path relative to what they want to do, and ensure that you're helping them, educating them, and making sure the choices they make are informed ones and they're not stepping into the world of risk, I suppose, as well.
Yeah, and I think this is where a lot of financial advice professionals have been, they've got a particular badge around it where a lot of people think, I don't need advice. But what you're chatting about there is, because there's perception that financial advice professionals just put you in the product, whereas what you're talking about is a lot more strategic and philosophical. It is a consultative approach. And no doubt a good financial advisor wouldn't go into any discussion with any particular bias. Their job is just to pull on the strings and work out what people's hopes, dreams, fears, status, all the stuff going on in their life. It must be a pretty close relationship you have to have with your financial advisor, right? Because you pretty much got to get naked.
You do, and the best outcomes come from that, and I have to as well. So I will absolutely be as transparent and open with people as I can when I'm sat across the table, and whether it's family things going on, whether it's my own setup of assets that I have, you have to be aware of your own biases when you're talking to people as well as theirs. Yeah. And ultimately, the best relationships come from that openness. And you're right, the process at the start we use is really trying to allow people to open up as much as possible, because the more I can understand about someone and their values and what is great to them and what they're worried about, the better I can provide advice and probably the better their journey can be. And it's, quite often you can sit across a table with a couple, and if you know the right questions to ask, there's conversations that happen that they haven't even had.
Yeah.
And one person likes one thing and one person likes the other. So how do you start to introduce openness around that between the pair as well as what you can help them with? So it's very powerful. But you're right. You need openness and you need vulnerability almost as well. You have to be comfortable being vulnerable, certainly as an advisor and hopefully as the person you're speaking to.
What's a catalyst for people typically getting advice? Is it something bad has happened and they need to fix it? I imagine it's more of I have an issue. It's more of solving a problem rather than being proactive and preventing a problem.
Yeah, usually a trigger point or an itch to scratch or whatever term you want to use. So sometimes it's bad.
An inheritance maybe?
Sometimes it's good, sometimes it's bad. So it might be that COVID was a great example of that, kind of turned everyone's worlds upside down, and you've had either people losing jobs or they couldn't go somewhere they wanted to do, their plans changed dramatically, they couldn't retire. So you have trigger points like that, inheritances, you've come across money. Or there's other cases where people have gone along a journey, and I spoke to somebody this morning. He said, I've kind of got this far, but I don't know where to go from here. Like I've just done the basics, and I feel like I'm not going to do myself justice unless someone tells me what else exists. So usually there are trigger points, or people get to a certain stage, 5 years before retirement, thinking, well, I've always thought about retirement, but how on earth do I actually do it? You'd be surprised. I get a year before. But a good, the earlier you can do these things, the more control you have over your journey in life. And, whether you're driven by assets and what pleasure you get from that, or whether you're really driven by the life you lead and having a great journey, a really enjoyable life and less bumps in the road.
And I guess that's, the question I was going to ask, how do you know you're getting good advice? But if you're getting good advice, it probably just means you have less bumps on the road, might be one way to view it. And it's the question, is it worth paying a fee for service for advice when in many times it's just someone triaging issues before they happen? You might not ever realise the good advice you're getting because you just have a good process. Yeah. I guess that's the win, right?
Yeah, it is. You've got to be comfortable with your value proposition, and you've got to help people understand that as well. So, if they go through a smoother year, 2 years, 3 years, they get informed decisions, they get to spend time with their family because they're not worrying about these things, then there is a value there outside of pure dollar return or tax structure, whatever it is that you're showing. So, you should be able to, and anyone that you're working with, if you're going to charge a fee for service and show a value, then there has obviously got to be a different strings to that, and whether it's dollar values based on strategy or whether it's, hey, you're going to spend way more time with your family this year because we've allowed it to happen via a bunch of choices that you just made.
And so people get the tangible versus the intangible because it's very easy to look at how your investments are performing, right? And when you look at property is sort of largely liquid. You're not sort of marking it every single day against the market, whereas other sort of financial assets or asset classes, you can look at it on a hourly, weekly, daily, minute-by-minute basis to go, am I up or am I down? So it's very, very hard as an advisor because you have good years and you have bad years, right?
Correct.
Property is a lot more forgiving if you're not transacting it regularly. You only realise a loss if you sell, and most people need to sell properties only at a negative level because they can't afford it anymore, right? That's the bad bit. If your financial advisor isn't putting property into your mix for whatever bias that is that good advice, do you think?
It's good advice if the person doesn't want property. So if you sit in front of me and you've had a terrible experience with property, I was speaking to somebody else this week about a place they bought in Gladstone when it was all boom and glorious, and now
people are still bleeding.
Negative equity. So would never touch property again because of that experience. So if that's their experience and they're saying, look, I want to achieve these things and I want to retire in 10 years, like this is what I've got, I just don't want to do it with property, then that is whatever the advice will be appropriate. So it's more about appropriate than good necessarily. But likewise, if you're sat in front of me and you like property and you like other things, then why shouldn't it be part of your setup? And that comes back to that point I made earlier. You've got to get to know the person you're speaking to. Yeah. My job is not to have a bias. My job is to help them make the right decisions and be aware of all the ramifications of those decisions.
Yeah, it's I've been hosting this podcast for a number of years now, and you know the numbers, but most Aussie investors, property investors, only hold between one or two properties, and one of the main reasons for that, and that is the significant majority, right? Like it's huge. And the reason for that is largely the first property they buy is the wrong property. And you chat about these sort of 10, 12 years ago, everyone buying up these properties in single economy mining towns. If you bought at the right time and sold at the right time, you made a lot of dough. But if you were left there holding, these assets when the mining boom turned into production away from sort of construction, people are still holding. They're still holding these properties, and I would see how they have a very negative bias towards property. What I would say, and one of the reasons why we do this property podcast, is to try and help people not make those bad mistakes, right? That's just a fundamental bad mistake. The quicker you can extract yourself from it, as a financial advisor will tell you, probably the best thing to do. If you're going to take a haircut, take it, move on, advance. But I sit there and I hear people buying real estate still in ways in which they probably shouldn't be buying this real estate. It happens time and time again. I just sit there going, how do people do that? This comes down back to sort of financial acumen, financial education. Like, people are still making the same mistakes, despite the fact that information and education is so democratized now. You listen to a podcast like this, free, speak to someone like you pay, it is accessible. But people still stuff up.
And you've got to be, at that point there, you've got to be comfortable with paying for expertise or information. So I think that selecting a property, for example, buyer's agents exist for a reason. And I myself have used one. Even in the profession I do, I don't have the time or the knowledge to go out and source the right properties because I know that I probably wouldn't do it correctly. So I use a buyer's agent because they know more than me and it's a good outcome. I think the point you made earlier about how do you, tracking and property, you don't log in every day and see what the value changes by, but you can with shares, for example. So there is a perception straight away there about how one performs relative to the other. I think if you looked at the property stats this year, on the whole, they may be down, but no one's running around selling their properties, or I doubt many people are. So sometimes the behavior around assets can have a big difference. If you pick over 10 years, if you're running in and out of things, it obviously has a negative effect. The other point around that, though, more broadly, is how do you track your own success or journey around all these things you're doing? Because it's very difficult for you to make decisions effectively unless you know that. So if you're sitting in front of me and saying, in 15 years, that is where I need to be, and in 5 years' time, one of your properties has done horrendously, one of them has done really well, things have changed, how are you making a decision there without understanding if it's going to affect your 15-year target or not? So if we're sitting down and saying, okay, if you want to sell that, here's what you've got to do over the next 10 years instead. There's a trade-off decision to make here. And if you do that, you're going to get there. That's how you make good decisions. If you don't track that part of it, then you're very difficult to make an informed decision. So
what does a good balanced portfolio look like today for your average Aussie, whether that even exists? Let's just call it, family with a couple of kids, mid to late 40s. Give us a sense what good is at the moment.
Yeah, it's a very open question.
It is a very, very open question. And by way of disclaimer, it's just a couple of guys chatting about investing here, right? Like, don't make any decisions.
No.
Anything we chat about. But give us some sort of baseline fundamentals and principles for our listeners to go, okay, I'm sort of thinking about it the right way, or they might go, oh God, I'm completely off the mark.
Yeah. I mean, so much of this is relative to where do you live? What is your lifestyle? So straight away, if you live in Sydney and you like the finer things, your timeline, your kind of setup at 40 is very, very different to somebody who has a quiet life in Adelaide. So there's always a huge risk in comparing to other people, even like-minded people. There's a risk. You never quite know what's going on in the background. I think if you pick 40s as an example, it's often quite a peak expenditure phase of life because you might have kids, you might have mortgages. So it's not uncommon to have that. But I don't know, many people probably want to be in their own homes by that stage and are earning reasonably and have a good plan in place as to how they're going to accumulate moving forward. There's no right or wrong about where people are there. I won't get drawn on that. It's risky.
Well, you've answered that exactly as I expect you to answer it, and it gives some sense to the need to interrogate. There's not one model fits all, right? Everything is absolutely individual. It's like a fingerprint, right? Like what's right for you is not right for other people. And a lot of it comes down to capability and capacity, but then it also comes down to, which is a bit more tangible, but then it comes down to sort of philosophy and mindset, and people are risk averse, people are less risk averse.
I mean, you mentioned before about a balance. To some people, a balance is not important. So if you're, you might be single and have no attachments whatsoever, you might have lots of money in the bank and
put all in crypto.
You take all the risk you like, and that's the best thing in the world to you, and you don't need a balance. Other people at the other end of the spectrum are petrified about debt, don't understand the difference between good debt and bad debt. And
do people still don't understand?
Yeah.
Like this.
Yep.
I think most people listening to this probably understand good debt and bad debt, but it's just bonkers, It's
well, and that's the point earlier about not assuming what people know, and also where the gap lies for advice, where people might just go and say, I'm going to take some debt. And if you don't know the difference between good and bad debt, straight away you kind of put yourself in a bit of a situation because you don't know the tax ramifications and many, many other things. So
it's bloody complicated. When you consider it and good and bad debt, I think, and you must have seen, you've been doing this for a little while, but just attitudes now, like the best time to get financial advice and education is when you're younger. Mm-hmm. A lot of people sort of make mistakes in their 20s, which hold them back in their 30s, and it's only when they're in their 40s they can actually start remedying some of those issues. But people, I call it strategic patience. People aren't strategically patient now. They want the immediacy of it, and particularly, I'm going to generalise here, but so forgive me, but sort of younger people, there's immediacy of I want it now and I don't necessarily need to wait for it. And a lot of people listen to this, younger Aussies listen to this podcast, and they're the ones that are enabled. You hear it, you must hear it all the time. I'll never get into a property; it's impossible. Or the baby boomers and Generation Xers have made it impossible. We get young people on this young sort of early-ish mid-20s coming on who have large property portfolios. They've bucked the trend to work it out. But the immediacy is the issue right now in education. And, the problem you have, and one of the things I find hugely alarming, and it's part of education, is that now there is companies that will give you your monthly paycheck early, right? So you got to sign up. This company signs up with an employer. So you end up paying them, they pay the person early. Like you just sit, you must hear this now just going, and they go, it's great, like Afterpay and all these sort of things. Like, it's great, it's an enabler. Like these are all traps for young punters. And if your kids are doing this and they want to have a healthy relationship with debt and finance and being able to actually invest in things to plan for a future, stop it straight away, right? But no one's really not saying enough of it.
Yeah, it's the education piece again, and that literacy that we talked about earlier. I think the concept of deferred gratification is lost on many.
Yeah.
But, often they haven't ever really sat down and understood it or had education around it. And if I was chatting to a guy this morning who's about 30, and in fairness, he said, I'm not here to make lots of money. Like, I actually want to have a great life. I don't want to work all the time to pay off my debts. I want to do all those things correctly, but I actually want to enjoy year on year. So it depends on who you speak to, but a bit of help in people understanding that if they do the right things over a lengthy period of time, they will get the rewards they need. Yeah. It doesn't have to happen tomorrow. And it's just about guiding people and making the right decisions through a year to make sure that happens along the way. And if they do that, and a lot of the time, the reassurance of having a plan and having somebody that helps you with it, keeps you accountable and keeps you on track, frees your mind to go and enjoy whatever it is you're immediately trying to enjoy anyway. So, if your big thing is you need to get some money because you got to travel twice a year, well, that's okay. Just put it on the table and make sure that when you're looking at everything else, it's factored in. So you're not missing your 2 holidays trying to get a property and then you get angry because you can't do either. So, be open, have a broad mind around it all, and then plan appropriately around to get great success.
How often do you sit there just going, it's just make-believe Disneyland a lot of people live in, right? They go, well, yeah, I want to enjoy my life, so I don't want to work too hard. So therefore, I just want to be a gig worker. But then I don't have superannuation. I don't have this. I don't have this. Don't have this. Like, you must sit there sometimes just going, you got a warped view of what reality is. Does that happen?
I don't have too many to that extent, I don't think. But I certainly have conversations with people that perhaps have unreal expectations. Look, managing expectations for people is ultimately how they're going to succeed or be disappointed. So that scenario you just described then, if that's your approach and you don't want any assets at the end of the day because you're happy just living on the age pension and living in, your parents' house or whatever it may be, that could be a great life for that person, by the way. So you kind of can't throw your own judgment on it. But you're right, there is expectations sometimes that need to be reset or help people understand what their current expectations or decisions mean.
How many people are sitting there at their investment strategy or their retirement strategy is just wait for their parents to cark it and inherit? Be a bit of that around? A
little bit. I don't meet too many that ruthlessly are waiting to do it at the expense of their own planning. Most people I meet are reasonably sensible around it in that there may be something coming in the future. Yeah. They'd rather not plan around it entirely, because I also have seen the other side of the coin where that situation falls over very quickly, where they're not aware of what the parents' wishes were and it all goes to charity or something like that. So completely flawed approach in relying on it. If someone sits across the table and tells me that they can wholly rely on it because they're an only child and they've seen the will or whatever it may be, then if that's their wish in the planning work we're doing, then I'll show them what that looks like.
Yeah.
But you've got to raise the realities with them that, hey, I also see the other side of this. There is a risk in doing that. So, but you're right, it's without doubt an influence because property in Australia has gone up a lot in our recent times. So there's plenty of older people sitting on quite a reasonably valued asset.
But to that point also, if you do have elderly parents and newsflash, you all die, you need to make sure those structures are right at a point in time before they sort of get towards the back end of it. And this is where a lot of issues happen, because this continuity of assets inside of families, it's there can be a lot of consequences, negative consequences in terms of tax and all this sort of stuff for the recipient as well as for the person who is passing on those assets. Like that is key estate planning, right?
It is, yeah. And like I mentioned earlier, sometimes it's accumulation as much as accumulation. So most people think of the start of their journey or creating their journey and building their property, and rightly so. But at some point, there needs to be either a plan around how that is exited or how there is an intergenerational wealth transfer. And the right structures, whether it's what entities you're owning the properties in the first place or estate planning measures, are absolutely critical. So if you're buying a place because you want to hand it on to your kids in 10 years' time, well, what structure are you using to do that? What's the right way of doing it? Because in 10 years' time, if you turn around and want to do it and you can't, you probably bemoan the fact that you didn't plan correctly 10 years ago. So that comes up a little bit in your right estate planning, making sure assets are treated in the right way. Yeah.
Let's go to another break. When we come back, we just want to continue down this pathway of how maybe investors should think about financial advice differently. Back in a moment.
Want to slash thousands off your home loan repayments? Whether you're an investor or homeowner, we know how important it is to find the lender that suits your unique situation and with the best rate. If you've not compared your home or investment loan in the last 12 months, you may be able to cut your repayments today with a different lender. That could mean more money in your bank account and less stress when it comes to paying your loan. Find out why more borrowers are turning to Finny to refinance their home loans. Call us now on 1300 002 023 and find out what you could save, or visit our website finny.com.au to book an appointment.
Welcome back, Phil Tarrant from Smart Property Investment with Adam Drinkwater, chatting through financial advice. Now, Adam, you've got the ear of tens of thousands of property investors who might have a reluctant relationship with financial advice. What do you say to them?
I would say ask yourself in your team that you have, do you get everything from them in terms of how they plan for you and who you are? So I know that in the world of property, we obviously have a team like mortgage or buyer's agents or your accountant, all have quite specific roles, and they're all people that we use as well. So if somebody comes in and they are going to do a property or something else, they probably need each one of those. I'd say we sit in a space that looks a bit more holistically at all of that and gets to know who the person is and whether your decision maker is right around it. So if you're a specific property buyer and you know everything there is to know about it, then so be it. Maybe you don't need advice. But if you're interested in it and there's lots of other things going on in your world and you don't really address how that fits in, then there is obviously a risk and a gap there. And, with respect to accountants, many of them, brilliant at the numbers, but a lot of them won't sit down and talk about the vulnerabilities that we talked about earlier and understand both parties or why they're doing it or what's their exit plan or what does this align with everything else you're doing and how you're going to have a better life out of that. So it's just about, I think, exploring that gap that probably exists where you use specific experts, but not necessarily somebody who looks at everything for you. And we introduce people to those experts as well. So we have a wealth of people that we're able to use, all communicate well with each other. So if I'm doing some work, it's like that I'm speaking to the buyer's agent or the mortgage provider and kind of fulfilling some value for the client there, so they're not doing the work either. Yeah. So it kind of makes a smoother journey that way too.
So it sounds like, it's strategic oversight over the tactical application. So you talk about accountants or buyer's agents, that's, once you work out what you're doing and why you're doing it, it's that tactical asset selection where they can help. I reckon one of the biggest mistakes I see property investors make is that they have the wrong accountant. There's a lot of really good accountants that are good at just knocking out tax returns, right, for PAYG employees, but the sophistication to know property really well from an accounting point of view, and a lot of it gets completely lost, and whether it's structure set up, whether it's how there might be small business owners. So, accountants sort of focusing on, tax minimisation strategy inside a business, which hampers lending capabilities and stuff. So to have that strategic oversight, I could see the role. A lot of people can do it themselves if they're financially sophisticated, but most people don't have the depth and capability to be able to have that holistic strategic view, both inside a property investment, but then also the other stuff we've spoken about is diversification.
Yeah, I think also as well, when you're chatting to an accountant, for example, you're going to know what the questions you're asking. And that's not specific to accountants, that's a lot of people. But I think we have really wonderful processes in spending time on engagement, in asking the right questions of people and not the other way around. And I think a lot of specialists or people that practice in one particular area ask you certain things and it's up to you to ask the right questions. So it does ultimately make a big difference. And I work with lots of accountants, and when I'm working with a client, whatever they're doing, I'm probably communicating more with them than the client is to make sure that the right things are being done. And we work with different accountants, whether it's, you're a small family and you're trying to get going, or whether you've got multiple entities or you've got international properties. I've got an array of people that I work with around those things. So most of the clients involved would probably happily tell me that they don't know what they're asking the accountant. So that's a part of it. And how much risk do you introduce if you don't do that?
Yeah, and that's not a bad way to look at it. A lot of investors, the known knowns, like, okay, you know what it is and you need to remedy it or look at it or leverage it a particular way. I guess where the financial advice sits is those unknown unknowns, right? It's the questions that you don't know you need to be asking. It's the stuff that you're not considering and thinking about is where good oversight from someone that knows the drill holistically is where financial advisor can really be a supporting engine.
Yeah, it's decision making at the end of the day as well. If none of our lives, our lives probably very rarely travel in a straight line or a smooth line, and whether it's things that come up in our own personal world or COVID or tax changes, whatever it may be, there are plenty of things that come up each year that you need to address. So either you're a specialist in all those things you need to address, or you need someone next to you trust and knows you inside out that can say straight away, no, this is what we need to do. Yeah. And that accumulation of those correct decisions over time is really powerful.
Yeah, and I think it's also this logic of, who was it? General Eisenhower, when he was Supreme Commander of Allied forces in World War II, he said something, and I'll probably butcher this, but it's pretty much the plan is irrelevant. It's the planning is the important bit. The planning, the discipline and the rigor of the planning supports the outcome rather than the plan itself. Most of the plan, as soon as you write it, chuck it on the drawer, it's dated, but it's the process of doing it.
Yeah.
And therein, I think, is what financial advisors do.
Yeah, I think you're right on the first part in terms of, it's the engagement work. The value is in the engagement and getting to know the person and getting the right outcomes to go into a plan, not making assumptions. So that can be really powerful in itself. They actually post that. The other powerful part is the ongoing accountability and work around it. So, if we've worked together to come to a series of strategies or whatever we're going to do, how am I keeping you on track to make sure that that's working? So at the end of year one, if interest rates have gone up or you've lost your job or whatever's happened, what are we going to do to change to make sure that you're not going to fall by the wayside here, or that you can continue on and make certain changes and decisions? So whether you align it to a ship setting its course and continually adjusting it, otherwise it would never get to its destination. It's the same kind of principle and concept. So you're right, getting a plan in place in the first place is what it is. The work that you do before that is hugely powerful and valuable. And then post that, making sure that you're adapting along the way and making the right changes at the right times and the right decisions.
Yeah. And sort of by way of another view of this is a safety net and accountability and just having someone working in your favour to keep good oversight. Like, how much does it cost? Now, most people are going, okay, this all sounds good. How much does it cost to have a good financial advisor? It's keeping an eye on things and helping you strategize and keep you accountable.
Yeah, it really varies from which company you're dealing with, which advisor you're dealing with, and how much work they're doing. So, you could have a reasonably straightforward setup and it might be a few grand to do a plan and a few grand a year to work together. There are much more complex people that I work with, whether it's multiple entities or there's some corporates we work with as well, which would be much bigger. So again, it's all relative to what are we doing together? What is the value you're getting out of it? Because that's ultimately how you're going to decide at the end of the day, or that's ultimately how you're going to look at your benefit over time. And if we're sitting here next year or the year after next and saying, look what we've just achieved over the last 2 years, as long as that's great and the value's in there, then the price should reflect that.
And how do you find a good planner? Because not all planners are created equal, right? And this is people tuning into this is they're obviously invested in property, right? So I would say you want a planner who has a positive attitude and aptitude towards property rather than a negative one? Like, what would be the question you would ask a planner to make sure they're the right planner for you?
Yeah, it's like many people that you choose to work with in life. You got to kind of make sure you get on and you've got a good relationship and you're on the same path. So, whether you're going off to find another specialist or an advisor, there's always that chance at the start to have a conversation, get to know what the person's all about. Yeah, you can look at stuff online to find out what someone's business is all about, but really sitting down over a table and just making sure you're on the right level. And we do the same, someone might call me and ask for advice and we might not be the greatest fit for them, and I'll happily tell them because they will get a better outcome if they go and find somebody that is the right fit for what they're doing, which is a niche that we don't operate in. So there's a responsibility there to do that. But yeah, it's like most things, most people ask for referrals or ask friends or ask like-minded people who they use, and lots of the people that we get introduced to are via referrals from either existing clients or accountants that we work with similar people. But it's that same principle, you ask the people that you trust who they work with or if they know anyone. And then we have a responsibility when we do get introduced to people to make sure that this is going to be a good relationship moving forward. Because if it's not, there's going to be disappointment on one side at some stage. So it's got to be a good fit. Yeah,
it's cool. Well, thanks for coming in, Adam. Having a yarn. It's
pleasure.
I'm sure our listeners are a lot more enlightened. Think positively about financial advice.
Well, look, if it opens minds and people are a bit more inquisitive about it and they reach out and kind of learn or want to speak to people, then that's a good start at the very least.
Job done. Financial education 101. That's what we're all about. It's Adam Drinkwater, partner over at Trayster Wealth. Thanks for tuning in, guys. We'd like to get different people in for a bit of a chat and give a more holistic view towards effective decision-making for smart property investors. I hope you enjoyed that. Please keep those reviews coming wherever you tune into this. So you get a real kick at it. If you're social media, you can follow us at Smart Property HQ, the website smartpropertyinvestment.com.au. See you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
HR Leader is your source of news, insights, and more for HR, leaders, and people managers. Subscribe today at hrleader.com.au.